Thanks everyone for coming. My name's Eric Basmajian. I'm a macroeconomic analyst focused on economic cycles. I'm going to present my outlook on the economy heading into 2020 and what the impact on asset prices may be. But before I do that, I'm just going to quickly touch on my background, my macro process, or how I think about economic cycles and why economic cycles are so important. I earned my degree in economics from New York University. I then went to work at Panorama Partners, a quantitative hedge fund focused on screening for mispriced equity derivatives. I took that quantitative edge and founded an independent research firm, EPB Macro Research, that takes a quantitative approach to forecasting inflection points in various economic cycles. In addition to EPB Macro Research, I'm also a contributing analyst on FATrader.com, a platform where 8 various industry analysts all provide research inside one interactive trading room. I would definitely recommend checking out FATrader.com. There's 8 different analysts from 8 different fields. So we have healthcare analysts, we have value investing, Lynn, who just walked in, she's our value investing analyst. We have a couple macro analysts, so there's a lot of different perspective all inside one trading room. So I would definitely check that out. I also consult for a global macro hedge fund doing work specifically on forecasting the probability of inflection points in various economic cycles. So as you can probably tell, we're very focused on cycles in the economy. We measure economic cycles across 3 time durations: secular economic cycles, business cycles, and the shorter term 12 to 36 month growth rate cycle. Secular economic cycles are multi-decade trends in growth driven by demographics and productivity. This chart shows the 10-year annualized growth rate of US final sales, or what I call core GDP. Final sales is a measure that excludes inventory and net exports, so it's a clean reading on consumption, government spending, housing, and business investment. The economy goes through cycles and experiences multi-decade periods of accelerating potential growth and decelerating potential growth. So a theme for this presentation and a core concept of our research is that it's the rate of change that matters. Whether we're talking about the secular economic cycle, the business cycle, or the short-term growth rate cycle, we're most concerned with the direction of growth, not the actual level of growth, or if growth is positive or negative. We always contextualize growth in terms of accelerating or decelerating. We often hear people in the media say that growth is good or this economic report was solid, but these are more opinion-based analysis. When we characterize growth in terms of accelerating and decelerating, it's more objective and less opinion-based. So US potential economic growth is very clearly in a secular decline driven by falling labor force growth and weakening productivity growth. Most of us are more familiar with the business cycle because the start and end dates are defined by recessions, which are frequently discussed in the media. The business cycle can be measured through the 4 big coincident measures of growth: industrial production, employment, consumption, and income. Despite popular opinion, a recession is not defined by 2 negative quarters of GDP. Rather, a recession is defined by a widespread decline in the 4 indicators in this slide. And that comes from the definition of a recession from the NBER, the organization that actually dates these recessions. So given that definition, we might as well use the exact data that they look at. So this chart here shows a composite index of industrial production, non-farm payrolls, personal income, and personal consumption. And our whole process revolves around these composite indicators, which we're going to get to a little bit more later in the presentation. So right now, most of the media suggests that growth is good and cites a low unemployment rate. But this coincident index tells a slightly different story. When this index goes negative or has a negative growth rate, that is a recession. But as I mentioned earlier, we're not worried about negative or positive, we're worried about the direction of growth. As the chart shows, the growth rate across this coincident index is decelerating. Furthermore, we have not yet called for a recession, but if we draw a horizontal line across today's growth rate, the growth rate today, which is just a basket of the coincident data points that we all look at, industrial production and employment, the growth rate today is actually at the same level as it was at the start of the last recession. So even though we have not called for a recession, and there have been periods of time where the coincident growth rate is lower than it is today and a recession has not happened, whenever growth is decelerating and at a level that's consistent with past recessionary periods, you just can't remove the risk of a recession from your forecast. So what's going to be the focus of the rest of the presentation is the short-term 12 to 36-month growth rate cycle. The growth rate cycle is characterized by these fluctuations in growth that happen within a business cycle. Since 2009, we've seen real GDP growth as high as 3.9% and as low as 0.9% on a year-over-year basis. So these accelerations and decelerations in growth within a business cycle are critically important to the performance of asset prices. This chart here shows the U.S. manufacturing PMI, which is a survey of purchasing managers used as a proxy for the growth rate in the U.S. manufacturing sector. A reading below 50 implies a negative growth rate in the manufacturing sector, but as I mentioned, we're less worried about negative or positive. We're more worried about the trending direction of growth. So within an economic expansion, there are very clear periods of accelerating growth and decelerating growth. We often hear that the manufacturing sector is a shrinking share of U.S. GDP, but as the chart shows, the U.S. industrial cycle is still very highly correlated to total economic growth. This chart shows U.S. industrial production in black and U.S. real GDP growth in blue. You could even make the argument that the industrial cycle, more often than not, leads these broader fluctuations in economic growth. So to forecast these inflections in growth that occur within the business cycle, we use a process of long leading indicators and short leading indicators. To briefly recap before we move on, we focus on three cycles. We focus on secular economic cycles, which are driven by multi-decade trends in population growth and productivity growth. The business cycle, which is defined by the four critical indicators of the economy. And the growth rate cycle, which are multi-quarter trends and the most important for asset price performance. To forecast these turning points, we use a process of leading indicators that stems from the predictable sequence of economic cycles. When we look at economic data and build our composite indicators, we separate data into three main buckets. Data that has a long lead time over coincident data, data that has a shorter lead time over coincident data, and coincident or lagging data itself. So we can look at some simplified examples of an economic sequence. So typically, a company would start to report a higher level of new orders before increasing the amount of hours their employees worked. After an employer raises the amount of hours worked, then they would begin to start hiring new employees. So a sustained acceleration in new orders today will likely have an impact on employment several months into the future. Another example involves construction. First, we typically see building permits increase before new construction starts. After new construction begins, construction employees increase. So what we do is we find data that logically leads in the economic sequence, and we test its performance over time. If we find it to be a logical lead of the economic cycle, and it proves to have a strong track record of leading economic cycles, we then add it to a basket of other data points with similar characteristics. We label these composite baskets long leading indexes, short leading indexes, and coincident indexes. Typically, long leading data moves about 8 to 16 months before coincident data like industrial production. Short leading data will move roughly 3 to 8 months before coincident data such as employment. Coincident data, like we described earlier, such as industrial production, employment, consumption, and income, are real-time measures of the broad economy. But this data is often too lagging for markets, and asset prices tend to move slightly after short leading data, but before coincident data. Markets typically move after short leading data and before coincident data and key off of data points such as the PMI. The time frame of these PMIs is right in the sweet spot for markets. Our long leading and short leading data both lead the PMIs, which have a heavy influence on asset prices. This chart shows the global manufacturing PMI, which is a survey of 13,500 purchasing executives about real events. So they ask them questions about their order book. Are you hiring new employees? Are you expecting to hire new employees? So they're real-time questions and less opinions. Similar to the US PMI shown earlier, a reading below 50 signals a contraction in global manufacturing growth. We're mostly concerned with the direction of these global cycles, which are correlated to US manufacturing cycles, which are correlated to total growth rate cycles. So there have been 8 down cycles in growth, which we have defined here, and 7 up cycles in growth since 1998. So what we did was we dated these periods, down cycles and up cycles, using several criteria, and we looked at the performance of assets during these down cycles and during these up cycles. During up cycles, the S&P 500 rose an average of 25%. During down cycles, the S&P 500 declined an average of 6%. Now, not every down cycle causes a decline in the S&P 500, but both the median and the average of down cycles are significantly below that of up cycles. Conversely, Treasury bonds, which are a defensive asset, decline on average during up cycles and rise over 25% on average during down cycles. We like Treasury bonds more than stocks when talking about economic cycles because they're more closely correlated versus stocks, which can deviate for longer periods of time. I'd note that 30-year Treasury bonds, virtually every single upcycle came with a decline in bond prices, and since 1998, every single down cycle has come with positive returns for 30-year Treasury bonds. So clearly, if possible, the optimal approach would be to be long of stocks or risk assets during these up cycles and switch to defensive assets or Treasury bonds during these down cycles. We did the same analysis, but on the 12 main sectors of the US stock market. So what this chart shows is the average performance of various sectors during up cycles and down cycles dated from the global PMI a few slides earlier. During up cycles, every single sector has a positive return on average, and most sectors like infotech, materials, consumer discretionary, industrials have large double-digit gains. During down cycles, the graph is almost flipped, with defensive sectors such as utilities, healthcare, consumer staples, and real estate having the only positive average return profile. Your best sectors during up cycles are often your most dangerous sectors during down cycles. And conversely, your laggards during up cycles are often your best performers during down cycles. As mentioned, US Treasury rates are highly correlated to these global economic cycles. US assets are global assets, so it makes sense as to why US assets respond to global data. This chart shows the global PMI from earlier, graphed in black, and the US 10-year Treasury yield, graphed in blue. When growth is accelerating, monetary policy becomes hawkish, and interest rates tend to rise. When growth is decelerating, like today, monetary policy becomes dovish, central banks start to lower interest rates, and interest rates typically decline. Today's decline in interest rates globally can very much be explained by a broad deceleration in economic growth. So I'd continue to expect interest rates to decline globally as long as growth continues to decelerate. This chart shows the same global PMI graphed in black and the year-over-year change in the S&P 500 in blue. The correlation between the two is not exact, but the trending direction is very clearly related. The companies inside the S&P 500 are also global companies, so it makes sense why these global slowdowns are relevant for profit growth. When growth is accelerating, profit growth rises, multiples expand, and equity prices tend to have a smoother appreciation. During down cycles, profit growth decelerates multiples contract, and cyclical sectors become vulnerable to declining earnings. It's clear that these accelerations and decelerations in growth are very important in determining the performance of stocks, bonds, and the disparity between sectors. So to summarize, before we get into the forward outlook, we're clearly in a period of decelerating global and domestic growth. And despite its shrinking size as a percentage of GDP, the US manufacturing sector is still very important in determining the total direction of growth. When growth is accelerating, risk assets perform better than defensive assets. When growth is slowing, on average, interest rates decline, defensive equity sectors outperform cyclical equity sectors, and recession risk is always on the table. The latest print in the global PMI showed a little bit of an uptick. So to determine if this is noise or the start of a new upturn, we use the process of long leading and short leading indicators discussed earlier. The reason we use these composite indicators or baskets of data is because no single data point has a perfect lead time over each cycle. The downturn or upturn in one cycle may be centered around housing, while another down cycle may be centered around manufacturing. By taking larger baskets of data that all move in roughly the same part of the economic sequence, we can filter out many of the head fakes and month-to-month fluctuations in any data series. We'd need to see a sustained positive inflection in a majority of our long leading indicators and before we even start to focus on our short leading indicators. If a majority of our long leading indexes show an upturn, we then start to focus more specifically on anticipating an inflection in short leading indexes. Once both long leading and short leading indexes inflect for a number of months, confidence in a sustained cyclical turning point is high. We're not looking for 1 or 2 or 3 months of positive or negative data. We're only looking to pivot our outlook when there's likely to be multiple quarters of accelerating or decelerating growth. As long and short leading data changes direction, the global PMI or these various PMI indicators typically start to inflect, and then asset prices respond, as we showed earlier. So as mentioned, we use several long leading indexes. This is one example of our global PMI leading index, which forecasted this slowdown with roughly a 15-month lead time. This index is not showing signs of a stabilization in global industrial growth until the start of 2020. While the rate of change looks like it will trough around 2020, which is important and positive, this index is specifically suggesting that the next upturn is likely to be of weaker magnitude relative to the 2016 to 2018 upturn in growth. It's worth noting that some of our long leading indexes are showing a stronger rebound in mid-2020, but 0% of our long leading indicators are showing signs of a sustained cyclical upturn in global industrial growth before 2020. One of our short leading indexes of US industrial production growth confirms the outlook, not showing immediate signs of an upturn in US industrial production growth, which is highly correlated to global industrial production growth. The highest probability outcome is likely to be a continued deceleration in global industrial growth. While some economies may avoid a recession, the trend in total growth is likely to continue following the direction of global industrial growth. Here's another look that'll help contextualize the state of the US economy. On the left are 3 categories of industrial new orders growth. From top to bottom, we have manufacturing new orders, durable goods new orders, and capital goods new orders, which is a proxy on corporate CapEx. All 3 measures of new orders growth, which are early movers in the economic sequence, are still moving to the downside. If we look at the 3 coincident measures of growth outside of manufacturing, we can see the top chart, which shows personal income growth, decelerating over the past 2 years. The bottom chart in green shows total employment growth at a 96-month low. In the middle, we can see consumption growth has remained roughly flat, the only major category not showing a clear deceleration in growth. It should be noted, however, that we have 3 legs of the 4-legged stool that are showing decelerating rates of growth. Consumption is ultimately driven by income, so should the manufacturing slowdown persist, which it appears it will, more job losses and weaker income growth could start to make consumption a little wobbly. If we start to see consumption growth tick lower, which we actually had a brand new consumption data point today, which showed a pretty significant deceleration, then we'd have all 4 sectors showing broad deceleration that, when aggregated, are at a level of growth that's consistent with the start of the past recession. And at that point, we'd probably start to get a little bit more concerned about a recession. For now, just a plain, continued, cyclical slowdown in growth is the most probable outcome. Another indicator that shows we're likely to have a few more months of downward pressure is the price of industrial materials. So a lot of people use copper or oil as a gauge on global growth, and those can be useful. But the ability to speculate on these commodities through liquid futures contracts can temporarily distort the economic signal. Copper rises every time there's a headline regarding US-China trade, but the demand for actual copper is not likely changed by a headline. This index of industrial commodities is published by the CRB and contains items that are harder to speculate on relative to liquid copper or oil futures. This index only prices once overnight, and it doesn't even trade daily, but it provides a very clean read on the price pressure from a broad basket of industrial commodities. A persistent downturn in industrial materials suggests price pressure is weak and demand is unlikely to be overwhelmingly strong. When we look back at various positive cyclical inflection points, we often see a 15 to 20% rise in the price of industrial materials. This basket of commodities bottomed in late 2015, well before the mid-2016 pickup in economic growth. With virtually no signs of life coming from various measures of industrial materials, argues against a cyclical upturn occurring in the next few months. Before concluding, since we are in a downturn, I thought it would be relevant to show how various equity sectors have performed relative to their average down cycle performance. The bar chart, which we showed earlier, shows the historical average down cycle performance in the global PMI, and the blue diamonds show the performance from January 2018 through last week, January 18 being the start of this current cyclical downturn. On average, the S&P 500 is performing slightly better than its historical down cycle average, up about 6% relative to an average decline of about 6%, but all of the sectors have performance that's roughly in line with its historical range. Utilities, real estate, energy, and information technology have experienced the largest divergences from their average down cycle performance. 3 of these sectors, utilities, real estate, and energy, are diverging in a positive direction or a direction that's consistent with our outlook. During down cycles, we'd be advocating an overweight position in utilities and real estate, so the outperformance would be to our favor. For energy, we'd typically be advocating an underweight or short position during down cycles, so the worse than average historical performance is also favorable to the outlook. The only sector that's diverging from the historical down cycle performance, but in a way that's opposite to what we'd expect, is information technology. From doing this same analysis on more granular sector data, I can say that the bulk of this divergence is coming from semiconductor stocks, which we think is centered around optimism around the trade dispute, shifting attention from the semiconductor cycle, which is decelerating and causing a larger price divergence than we'd normally expect. Other than those sectors, most of the performance is in line with its historical norms. Now, before closing, I have 3 more quick charts to highlight what's priced into the stock market today relative to the economic data we just saw. So this chart shows the estimates for full year 2019 S&P 500 EPS growth. In other words, 126 days ago, Wall Street was expecting full year 2019 EPS growth to be roughly 4.6%. Today, those estimates have fallen to 2.5% due to the larger than expected deceleration in economic growth. Based on forward-looking data, I'd likely be in the camp that these estimates are going to continue falling. This chart shows the same data as the last chart, but for full year 2020. There are two things to note from this chart. First is that the EPS growth in 2020, the estimated EPS growth, is coming down, similar to 2019. But the second point to note, however, is the inflection in growth from a currently estimated 2.5% in 2019 to 10% in 2020. The estimates for 10% EPS growth continues into 2021. So right now, we have data that's not suggesting an upturn in economic growth is imminent. A stabilization in economic data in early 2020 is possible based on our leading indexes, but to expect a sharp acceleration in growth seems more speculative at this point rather than data-driven. Nevertheless, the equity market has optimistic assumptions baked into the price, including EPS growth inflecting from 2.5% in 2019 to 10% in 2020 and staying at 10% in 2021. So clearly, there's no recession in this earnings forecast, and while we haven't made the call that a recession is an imminent probability, we can't rule out the possibility of a recession and growth decelerating further. So should growth continue to decelerate and employment growth continues to cool, it may start to impact consumption growth. And if that's the case, then these assumptions are likely overly optimistic. To summarize, based on our long and short leading indicators, as well as industrial commodity prices, global and domestic industrial growth is likely to continue decelerating through year end. As economic growth decelerates, defensive assets such as bonds or defensive sectors such as utilities, real estate, and consumer staples typically outperform risk assets such as cyclical stocks. When growth slows, the Federal Reserve typically eases monetary policy, and lower growth is likely to bring lower interest rates across the entire curve. So I'm going to pop up some contact information. I'd encourage you to check out fatrader.com, and if there are any questions, I would be happy to answer them. Any questions? Yes, sir. Yes. Right. Right. That's a common question. Two things I would say to that is if we were truly at full employment, we'd likely start to see income growth start to really accelerate. But as I showed in the income slide, we're actually seeing broad measures of income growth continuing to decelerate. And it's not just demographics, but we also have 96 million people or thereabouts that are not in the labor force or that don't have a job. And there's more to that than just demographics. So a low unemployment rate can be deceptive. Off the top of my head, I think Japan at one point had an unemployment rate in the 2% range, but that wasn't really significant of a late cycle or income growth or inflation for that matter. Yeah. Yeah, people not included in the labor force. People not included in measures of labor force. Yeah, 18 or 18 or over. Yeah, of course. Yes. In the United States? Which interest rates specifically? 10-year Treasury rates? I don't put a specific point forecast out there. So my forecast is as long as growth continues to decelerate, we're going to continue to see lower Treasury rates. But if I had to put a guess out there, I mean, I could see us easily going below 1%. If this economic cycle ends in a recession, or this slowdown ends in a recession, then we could definitely see 10-year rates below 1%. If this slowdown in 2020 inflects higher, we could be closer to the low in Treasury rates, but we're likely to see growth continue to slow over the next couple of months. So, we're probably going to see Treasury rates continue to decline. I think below 1% is realistic. It's possible. I think it's probably early for that. For negative interest rates in the U.S., we'd likely have to have a pretty severe recession and deflationary fears. Given the structural trends in demographics, it's unlikely that we're going to avoid this continued decline in growth. So in the future, that's certainly a possibility. So yeah, I think it's possible, but it's probably early for now. We'd have to have a pretty serious recession and some deflationary fears, and we're not quite there yet. Sure. No, go ahead. Yeah. Right. 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 So I don't try and forecast the immigration trends. When I look at forward projections of population growth, I typically take the estimates that come from the Census Bureau, and they factor in immigration into those estimates. But I don't try and override their forecast and say I think immigration growth is going to be stronger than the Census Bureau currently forecasts. If you have more, if you have more labor force growth, yeah. Yeah, like I talked about in the first slide, the main secular trends are driven by labor force growth and productivity growth. So if you have more people coming in and you have stronger labor force growth, then your trend potential increases. But the current estimates from the Census Bureau and world population estimates for the U.S., considering things like immigration, is that it's going to continue to decelerate all the way out through 2060. I think we have population growth around 0.7% now. 10, 20 years into the future, that estimates are closer to 0.5%. So that vector of the secular economic trends is going to continue to, and those estimates are pretty accurate over time. Yeah. I haven't worked through the implications of that specifically. As far as AI, I think what you're trying to hit on is productivity growth, because yeah. So it could work. It could work in both ways. As a population, perhaps we get less productive if there are less people working. You would really need AI to have a step function increase in productivity growth. So, a lot of people say that productivity growth may be mismeasured. We've had so much technological change in the past 10 years. Why isn't productivity growth going up? One example I've heard, which summarized it perfectly, was the difference between evolutionary technology and revolutionary technology. So iPhone 1 to iPhone 10 has been a lot of technological change, but that's an evolutionary type change. Change that we're looking for that would really change the trajectory of growth would be like the airplane, the steam engine, highway systems, things that have a step function increase in the productivity, not a new fitness app. Yeah. Yes, sir. Yes, the deceleration in growth. Yes, sir. So our current forecast is in early 2020. We can see a possible or leveling off of that growth rate and a possible upturn. But right now, the possibility of an upturn or a change in direction of growth occurring before 2020, so the next 4 months, is a low probability in our opinion. Yes? Exactly, that's exactly right. Right. That's exactly right. So we measure performance of assets from these inflection points in growth, and this deceleration in growth started in January of 2018. And since that point, like you said, the S&P 500 is only up about 5 or 6%, but a lot of sectors like financials or I think maybe even small cap stocks are actually down since this January of 18. So we've had 18 or 19 months with virtually no equity appreciation in a lot of these sectors, which speaks to that deceleration in growth. That's a good point. Any other questions? All right. Thank you very much.